now, Property Monday continues as Margaret Lomas and her team answer all on Your Money, Your Call.
Welcome once again to our Monday night property edition of Your Money, Your Call. And this week we have a fabulous show all ready to go and a great panel on hand to answer your questions. Helping me to field your inquiries tonight is Brad Beer from BMT and Brian Haratsis from MacroPlanDimasi. And tonight we're focusing on some exciting future gazing, discussing the factors which may affect property and also answering your depreciation questions. Now you can be part of the show tonight in a number of ways, either with a comment about our headline topic, a question of your own, or to just give us your feedback. And you can do it three ways. Call us on 1300 30 34 35, tweet me on Margaret Lomas AU, making sure that you hashtag YMYC, or email me right now on property@skynews.com.au. Well, thanks for being with us tonight. Sit back and enjoy the program. Let's start with you, Brian. Now, we've been having a wonderful time on Property Success, haven't we?
We have. It's a lot of fun, that's for sure, Margaret.
So for those viewers who haven't tuned in on Saturdays, Sundays and Friday nights, Property Success is obviously a property education program. And you have a new segment on that, which is all about future stuff.
That's exactly right. Some of us have to think about the future, and I guess kind of things I tend to think about are not what's happening next year or the year after, but in the midterm, what do we need to look at? Is it employment? What's the next big service industry? Where might the next key worker want to live? Is tourism actually really going to work? So there's lots of exciting ideas, and what I'm trying to do is to perhaps create a different landscape for people to begin to think about their property investment decisions in, because sometimes we all get a little bit sort of stayed and we start to think inside the box.
Yes.
Well, you know, making a buck out of property is really more about sitting outside the box than inside the box.
Yeah, look, I love it, obviously, because for years I've been trying to get people to step back from those emotions, disconnect with the purchase, and then look at all of that kind of stuff, things that create growth in the future. What would you say some of the big ones are?
Oh, look, some of the big ones are really looking at future employment trends in Australia. There are some huge changes. Let me give you a great example. Health is the #1 growth service sector industry in Australia. If we looked at 4%, 5% per annum compounding capex, largest employer by the length of the strait, key workers, specialists, allied health. So what we have now is a new landscape of business, 24 hours, 7 days a week. So where do you want to live if you work in the health industries?
You need to live near the hospitals.
Correct. And so there's been this huge growth. So if we go to places like Westmead and begin to, that's the biggest single aggregation of health industries in Australia.
Look, I want to just caution the viewers though, because I often get people who come up to me at property shows and expos and things like that and say, I'm going to buy in X area, and when I ask them why, they'll say, well, it's because they're getting a new hospital and that's the only thing there is a hospital. And it could be that it's an ageing population, therefore they need either an upgrade to the hospital or a new small hospital. Really though, people need to look for those big drivers, but they need to make sure that other things are there too. So other services to support that community other than just the employer.
Oh, absolutely. So it's two things. Firstly, it's clustering. So it's not just one hospital, it's the cluster, it's the private hospital, it's the pathology, it's all of the component parts. So that's the first point. But also it's the vertically integrated community amenity that goes with it. So just having a hospital, if the hospital is actually located out on its own in a location, you'll find no economic multipliers and no benefit.
Exactly. And that's the thing that I'm trying to get people to see, that when it comes to growth drivers, it's the concert of factors rather than the individual factor that becomes important when you're making that decision.
Oh, absolutely right. One of the things we always say to ourselves is, have we seen an example of this before somewhere else? And if it was out on its own, what did it look like? And if it's Westmead, what did that look like? And what can I learn from that? But then the big question is, how do I interpret that for the specific case study I've got? And that's where the skill, and that's why these kind of shows are really important, because we're talking through these factors so that people can begin to sort of broaden their horizon on what you might take into account in that next big investment.
Brad, I know that when you invest personally, you've got a lot of investments yourself, that you know, you and I have talked for years about how we invest, and one of the things that you've always done is ignored that whole emotion, and you just gone for the stuff where you see those kinds of things that Brian's talking about, the employment nodes and just the, you know, the family demographics and those real basics, rather than look. You know, so many people look to an area that they might aspire to live in themselves without realising that they missed that boat. They've got to go for the one that's going to become that in the future.
And that gives you probably more of the flexibility to buy that one in the future that you do want. If you can make the money out of the things that you buy otherwise, then that house that you want to be in at a later stage has got more opportunity to be reachable at a certain point. Now, I have always looked at many things in relation to the property, not been stuck on this is the area I love, been stuck on the things that I believe have ability to grow, stuck on properties that I can make some sort of difference to, you know, do something different to it to actually make it worth more money over time. I've done a lot of renovating because I can buy, add value, revalue, get better rentals than the current property was actually getting, and try to find those things that and never being emotionally attached to that actual purchase. I can walk away tomorrow, I don't care, so you can put a bit more pressure on in the negotiation purchase that way.
Yeah, absolutely.
Process.
Now, we've got plenty more to talk about this, and I want to get into more of a discussion around this whole future stuff, because I know you've got a lot more as well, Brian, but let's go to our emails first, and our first one comes from Doug, and it's a question for you, Brad, and he asks, I have recently bought a property in the UK. Can I claim depreciation on this property? Good question.
Yes.
I mean, you probably can, but can you claim it here might be more to the point.
So if you've got income in, if you're bringing the income back to Australia, then you can depreciate that UK property, and you'll actually do it under the Australian depreciation rules.
Ah, what about if you've already done it, depreciated it in England? You can't double depreciate.
See, I don't think there'll be a double dipping exercise.
No double depreciating.
No one likes No one likes things to be double dipped, unfortunately.
I don't know. I don't mind a bit of double dipping every now and then. How about you, Brian?
It's pretty good for me.
But quite simply, you'll apply the Australian depreciation rules to that property, providing you're bringing that income back to Australia. And the difficulty is coming up with the construction costs and things from the UK.
Can you do that?
We don't actually do it because trying to do that and rest on the actual construction costs in a different country is a little bit more difficult in Australia. There's not many that actually need to do that. So the number that's involved in doing that, we have done them and can actually do them because they're really under Australian rules. It's just coming up with the construction costs. The methodology to do it's actually not that difficult because it's really an Australian depreciation schedule.
So I guess, you know, the answer to the question then is yes, but providing you first of all find a quantity surveyor in England who can do the reports or some kind of a schedule, or at least give you some costs.
Yes, so you need to come up with some sort of cost for that building so that you're applying those things correctly. Under the Australian rules, it's very easy to change it over to the Australian rules.
And so the same rules apply, 40 years on the construction, providing it's built after a certain period of time, all that sort of stuff still applies. Well, who'd have thought?
Yeah, so, now if the income has to come here is the important test.
Okay. So long as you're prepared to bring the income back into the country and declare that and pay the relative taxes on it, and one would assume that that's going to be most likely a positive income, because if they've owned it, well, unless they have a loan against it, I guess, in England, through an English bank.
Yes, so there's a lot of other, the question has a lot of other things related to it around your tax. So can I depreciate it? The answer is yes. If you bring the income here, it's a small part of your overall tax affairs in relation to that property from overseas, though.
Brad, just one more question in relation to this. Does that apply to all countries, or only countries where we have a taxation agreement with?
Not all countries.
So if I buy it in, like, out of Mongolia?
May not be the same.
May not.
Some countries even, the rules between states are slightly different and may not actually apply absolutely everywhere in the same country. It's not as cut and dry simple as it sounds. UK, it is. Some countries it is, but some countries it isn't, and most are though.
Okay. So have you got like a list? Countries?
No, but it's not hard to find.
Is there a list? I suppose the tax office could help you to find that out. If you're watching the show and you have a property in another country and you want to know if what Brad has just said to you can apply to you too, then give the tax office a call. Make sure you get the person's name and write all of that down, and then see how you go from there. Well, thanks for tuning in. If you also have a question for us tonight, make sure that you ask it. Because if you do, you may be in the running to receive one of my books selling in the stores for $39.95. Now, as we do every week, at the end of the show, the panel and I choose one question from the emails, the calls and the Twitters. So the tweets. And so we choose one from each and we send a copy of one of my books. This week, the best email will receive my brand new book, How to Achieve Property Success. And if you're ready to invest, this book will make sure that you cover every single part of the process. Now, remember, that's 3 books altogether tonight. And to get hold of your copy, you do have to ask the question. You can do that by either calling 1300 30 34 35. You can tweet me on Margaret Lomas AU, making sure that when you do that you hashtag YMYC, otherwise we can't find that, or by emailing property@skynews.com.au. And then you make sure that you watch at the end of the show to see if we choose your question. We're heading off for our first break, but we won't be gone long, so stay tuned. You can call, tweet or email while we're gone, and we'll get to your question as soon as we can. Welcome back. Thanks for joining me this Monday night. I'm Margaret Lomas, and joining me tonight is Brad Beer from BMT, Brian Haratsis from MacroPlanDimasi. Don't waste any time. Call us right now on 1300 30 34 35. Tweet Margaret Lomas AU, or of course, you can email us on property@skynews.com.au. Let's go to news now. And in news this week, if the British government follows the vote of the people and removes itself from the European Union, the Australian property market might just benefit. While a formal exit could take up to 2 years, REA Group Chief Economist Narita Conisbee said the uncertainty which emerged could impact on the commercial property market in Australia. Ms Conisbee said Australia tended to attract a lot of global capital for commercial property, and in many cases would usually be competing with locations within Europe for this market. She said that with the level of uncertainty now in Europe and Britain, Australia will now look even more attractive for commercial property seekers. Do you agree with that? And I believe you, because I know you know this stuff.
Well, commercial property is really sport for me. I love it.
Oh.
But the answer is yes. I actually recently hosted a group of merchant bankers from Europe in Australia. 32 came here looking to begin to invest.
It's been so exciting.
Well, there wasn't a lot of jokes told, I can.
I can't remember one merchant banker, let alone 30, but anyway.
Well, the interesting thing is, of course, the kind of yields they're looking at in Europe are substantially lower than the yields that we've got here. And one thing that really is not widely appreciated is that a lot of our lease covenants here are extraordinarily strong. And so, you know, you look at lease covenants with Coles and Woolworths and some of our major corporates. I mean, they're very good lease covenants, and you're picking up yields at 6%. Well, you know, in Europe, you're picking up yields at 3 and 4. So, you know, they are actually quite amused and amazed about the way Australia works. So I think there's a bit in this idea that Europe might begin to look a little bit more outward-looking than inward-looking. And I also think where there's chaos, there's money. And
you said that to me. I love that. I'm going to use that. Can I have it?
You can have it, but it's true. Where there's chaos, there's money. And so, you know, people will be looking for what are relatively safe havens with very good lease covenants, and with the dual-listed companies from Australia very well known overseas. It's quite an obvious thing to do, to look over here and say, oh, well, 6%. Wow, you know, we can buy a very good lease covenant.
Now, Brad, we don't talk about commercial property very often on this show, although that doesn't mean we don't like it, because we do like it. It's just that for a lot of people, the thought of getting into a commercial property carries added risk, which of course it does. And it's unlikely that we can get into the kind of commercial property that has someone like a Woolworths or a Coles in it, because that's usually something fairly big. But for the investors who are interested in smaller commercial, does all of the depreciation benefits still apply? Yeah,
look, the rules in commercial property are very similar, almost the same. The fact is, there's probably, depending on the type of property it is, like small industrial units don't have as much plant and equipment as a percentage often, because they're, you know, a few concrete walls, and you don't have kitchens, and well, you do have small kitchens and small bathrooms. There's not as many plant items, but effectively it's 2.5% of the write-off against the Division 43 building allowance. And the plant equipment items, most of them are basically very similar in their write-off rates. So yeah, it applies.
Okay, so
One other thing, the date that the building allowance actually comes in on a non-residential property actually goes back to 1982.
okay, so
So
earlier.
a slightly older building can still get the 2.5% on the construction.
Okay, although we're going to be running out of time on that, being 2016 now, there's only another 6 years. Then if it's 40 years.
2000 and
Yeah. Wrong?
Yeah, so 1982, so 40. Yes, only a
My
few
math
more
is
years to
good.
go. Yes.
Funny.
Anyway, yeah. So not many years left on that, but there has been that benefit at least. You know, it's a bit like the 85 to 87's gone.
Yes, for
and
resi.
the
yeah.
2.5% for that right back to the start will disappear pretty soon.
We used to talk about that in the early days, how great it was if you could score that building between 85 and 87 because you got that extra building write-off. But now, of course, anyone who took our advice then might not like us anymore.
Well, yeah, suddenly it ran out.
Yeah.
1987, 2012.
We didn't think it would come this quick, It was like Y2K and next minute it's 2016.
So yeah, well, back in 98, I started at BMT, and there was plenty of time left for it.
Yeah,
then.
there's still lots left then, wasn't it? Wow. Well, let's go to the callers. And Nancy from Sydney, how are you going, Nancy?
Good. Hi, how are you?
Good, thank you. What can we do for you?
I have 50 acres at Kalala Beach. And I've had it for 25 years, and I'm just hoping that something may come of it. What do you think?
Do either of you two know the area?
I do.
Okay, what do you think?
Well, I like the beach.
Nice.
I like the beach. I like the golf club. I like the RSL. I mean, it's got some great facilities there. I mean, I see.
Quite small and quite, caravan park there, and it's quite.
It is today. I mean, I think the issue is this: that if you really thought about the south and the Illawarra and how tight the markets are in Wollongong right now, and the fact that there is supply. There is land supply, but it's not practical supply at the moment, so there's no land supply. You've got the Greater Macarthur area coming on, which in the next 20 years is going to be the big thing. So here we are sitting a little bit further south of that. What's going to happen? So the question is, I think the answer to the question would be timeframes. That if you're really interested in this being a property worth a lot of money, I would be long dating yourself and I would be holding it and I'd be giving it to my kids, because I think depending on how it's located in relation to the rest of the settlement, is it close, is it not, can it be rezoned, can it not, could it be a caravan park, could it not? I'd be thinking to myself, it's actually quite strategic, although not today.
Yeah, no, I agree, and that's certainly my thoughts. It's one of those areas that is beautiful and attracts some holiday makers, and it's still quite villagey, and golf club and RSL club, which many of those areas do have. But as far as having a population which is quite dense, it's still some way off that. But Brian seems to think that in the future there's going to be an opportunity for that. I'd say long dated, 15, 20 years. Down the track, most definitely. Whether you want to hold on to it that long or not, then that's up to you. A good idea to maybe leave it to your children and let them benefit from it in the future. Nick from Sydney, how are you going, Nick?
Hi, Margaret and panel. How are you all?
Good, thank you. What can we do for you?
Margaret, just wanted to get the panels and your opinion on. I'm looking at investing in Padstow in Sydney. I've done a little bit of research and. There's a lot of homes have been bought by developers around the stations of Padstow and the surrounding suburbs to build some boutique units in the future. And I'm looking actually at a unit in Padstow at the moment, an older unit, and just get the panel's opinion on the capital growth of this area. It has a lot of infrastructure close to Hurstville, Bankstown and the city. Just looking to maybe looking in that area.
Okay. Now, Brad, here's a fun fact. I was born in Padstow and raised there for 21 years.
Wow.
So does that decrease its value or improve it? Probably decrease it. Probably decrease for sure. Now, you look, when my parents won the money from, when I say won, they were drawn out of one of those lotteries that the building societies used to have to decide who they were going to give the money to. But there was only certain parts. It's an old thing they used to do years ago. Certain parcels of land that you're allowed to buy with that. And when they bought the block of land, it was considered way out in the sticks. It was like Kalala Beach, basically. So way out in the sticks that it wasn't funny when they first built there. Obviously, this is a long time ago now. When my sister was young, so we're talking 60 years ago. But its location, of course, now is considered quite a prime location. As the caller has said, Hurstville, Bankstown, you've got some pretty big centres around it as well. What do you think?
And I guess there's ability to get to places. There's trains. There's
very good train line, very good bus line, not far to the big hospital, Bankstown Hospital.
And so you're very connected. So as far as a connection point of view, and the fact that the developers are buying older houses around to look at, I think Sydney, like many places, needs to not just spread forever, and we actually need to probably increase the density around these areas in order to maintain the supply of property into the long-term future, which they are doing in some areas, like in Perth, in some suburbs. They've done that over time. We've had a lot of substantial growth in the Western Sydney corridor over the last little period of time. Probably unprecedentedly large amount of growth, which always concerns me about growth into the short to mid-term future. The prices have been pushed very hard. The yields therefore become very low. So we're investing in property, pushing on the concept of growth over time. And I think fast growth in the short period is probably something that's going to struggle.
And just quickly, Brian, Padstow is typically very much a family demographic.
Yep.
I remember when the first units were built there, and that would have been in the 70s. And it's probably the ones that he owns, because there was only one block along the shopping strip there.
Yep.
I'm just not sure that there's going to be big pressure, if there's any at all, on units in Padstow, but maybe I'm wrong.
Well, I think what I'd be inclined to look at would be the arbitrage price between the new apartments and units. And one of the things I think, have a hard look at that, because I quite like sometimes if the price arbitrage is okay, and the rent levels you can actually achieve at the moment can give you that maybe 3.5 to 4. You might actually have some interesting capital growth catch-up. So I think it's just an interesting way to look at, given the way that there's a lot of units being built around Hurstville. Sorry, apartments.
Lots of them being built around there. Okay, well, that sounds like some good advice. There you go, Nick. Maybe hang on to it for a little while. Work out the value of the property you currently own versus the new ones that are being built in around the station there. Hope they didn't take that old pub down, though, to put the units in, because Padstow pub really was something. And then, if there's a big gap between them, then maybe hang on and see if it catches up once they do get completed and sold. Well, I hope you're taking this time to learn a bit more about property investing. We do have to pop off for a quick break, but we'll be back soon. Now, if you have a question for us, call now to join the queue on 1300 30 34 35. Tweet me on Margaret Lomas AU, making sure that you hashtag YMYC, or email property@skynews.com.au. You never know, you could be the lucky winner of the question of the week. We'll be right back. If you've just tuned in, you're watching the Monday night property edition of Your Money, Your Call, and helping me to solve all of your property investing dilemmas is Brad Beer from BMT and Brian Haratsis from MacroPlanDimasi. So call us right now on 1300 30 34 35 to join the queue. You can tweet Margaret Lomas AU, making sure that you hashtag YMYC, or even email us on property@skynews.com.au. So let's go to the phones. Robert, you're from Sydney. Welcome to the program.
Thank you very much. Got a question for you regarding land tax.
Yes.
I was told that if, for instance, I owned a property, this is New South Wales, worth $1 million, and the threshold, I think, is currently about $430,000.
Correct.
So you would pay $100 plus 1.6% of the balance of from the $1 million to the $430,000. Now, then I was told that if it was jointly owned by two people, that in turn they would calculate based upon $500,000 each, and in turn deduct the $430 each from the $500,000, and working on the $100, then the 1.6 on the balance between the 500 and the 430, you would in turn apply for a refund from the Office of State Revenue. Is that correct?
I'm not sure about the whole refund, but you know what? Even though Brad isn't an accountant, he has a lot of land tax problems. So I'm sure that he can answer this question.
If I had the answers to land tax, maybe my bill wouldn't be so large. Not an accountant, but I understand there's a threshold. So there's a threshold for, in my situation, a threshold for me and a threshold for my wife, which means you've got more than one threshold. One thing on your $1 million property, it's actually, just remember to consider, it's actually the land value, not the actual property value that you need to consider there, that your land tax will be actually calculated on. But yes, I don't know about the refund, but I do.
Well, look, I don't think there's a refund to get, because your $1 million would be halved to 500 each. You'd get the threshold each of 430, and then you pay tax on what the difference is. So there's no refund to get, because you haven't paid anything in the first place to get refunded. And remember, land tax is not the same as income tax or anything else. So you've just got to pay that land tax to the Office of State Revenue. It doesn't have anything to do with your income. It's not means tested. It's nothing like that. It's got to do with the value of your assets, not including your family home. Now, to find the land value, that's simple, because in New South Wales it is the rated land value. So whatever your rates notice says your land value is, that's what's used to determine the land value. Then you go through the same process. If it's jointly held, you apportion it to each person according to their ownership value. If it's joint tenants, it'll be 50-50. If it's tenants in common, it could be different than that. So you apportion it to each person, you take off each threshold, because you each get a threshold, and then you will pay land tax on whatever the difference is. Don't forget, it's cumulative, so you don't get a threshold against each property. It's against the cumulative value of all of your properties together. So hopefully that helps you out a little. Let's go to our email. This question comes from Leon, who asks, my wife and I own 6 properties in regional Victoria with a net income of $60,000 a year. We work part-time and we live off some of our property income. I'd like to buy another property in regional New South Wales or Queensland to avoid extra land tax, or should I buy closer to the CBDs? Now, this is a good one for you, Brian. It sounds to me like Leon likes the regions. He's probably done really well out of them. And if you'd invested, you know, in the last, say, 10 to 15 years, particularly if it was about 8 years ago, some of our big regions did really well.
Absolutely.
And we saw some big values growth. Places like Shepparton, Bendigo, Ballarat, in New South Wales, Bathurst and Orange, we saw some good values climb. Is now the time to be investing in the regions, or should people be focusing on the suburbs of our CBDs?
Well, there's 2 different types of regional cities. This is the big issue at the moment. The regional cities which are within the labour sheds or within the influence of capital cities are actually still growing, and growing quite strongly. So we go up to the north coast as far as Newcastle, we can see that. And in Melbourne, you can see Ballarat. Ballarat's growing at about 1.8% per annum compounding. But when we move outside of that 2-hour band, let's call it, max, what we're beginning to see is depopulation and lots of pressure on rent. So the first thing is there's regions and regional cities, point number 1. So if you focus on the regional cities that have got really good fundamentals, and Ballarat and Bendigo would be good. Newcastle's another great example. You know, Wollongong's an interesting opportunity, sort of intervening type of opportunity. If you were looking for capital growth, I would suggest that you stick to the regional cities that you know so well, because you've done well out of them. Because I think, and there was a comment you made before, Bradley, that some of the middle ring suburbs in Melbourne and in Sydney are actually quite overdone at the moment, and you might find it quite difficult to get your capital growth. So I'm sort of sticking in the regional cities area, but with a lot of due diligence.
Look, correct me if I'm wrong, Brian, but you're more or less saying that those regional areas that could, with our sprawling cities, that could otherwise be considered very distant suburbs, like, for example, where I live, the Central Coast, considered a region. However, a lot of people, 60% of the working population, commute to Sydney for a job because they can. It takes them up to 2 hours each way to do it, but they do.
That's right.
And I'd venture to say a lot of that happens in Melbourne as well. From a lot of those, you know, at Sunbury, further up toward Ballarat, they'll commute if they need to.
That's right.
So long as they are within spitting distance of being able to get into some kind of employment node, even if it's an employment node which exists in the outer of the suburb of the city. In Melbourne, we've got a lot of employment nodes around the edges of
Absolutely,
the city.
Melbourne Airport.
Yep. So Tullamarine then is really in easy reach of places like Ballarat for commuting purposes.
That's absolutely correct.
But if it's unreasonable, and Newcastle's separate, Brad, because Newcastle is kind of a city in itself, so that's a little different. But if you can't reach a big metropolis like that to work if you needed to,
That's right.
then it's probably off.
That's exactly right. I think that's the right test for it. Yep.
Good test.
Yes.
We should name that test. It could be something we've come up with.
Haratsis test.
I was thinking the Margaret Lomas test.
The beer test?
The beer test. I think people might confuse that, but we can discuss that later,
Okay.
Brian, and we might come up with something. How about the Lomas Haratsis test? Something like that.
We'll go with it.
We can come up. Well, look, here is another question tonight for Brad, and it's from Anita. And Anita asks, I ordered a depreciation report for a brand new house, and it has a 10-year schedule. Now, since we can depreciate some things for 40 years, such as the construction, what do I give my accountant for years 11 to 40? And do I need to get a new property report done every 10 years? Either she's had a bad report done. Oh, there's more. Sorry, there is more. Should I have ordered a 40-year depreciation report, or can the accountant use the 10-year report for 40 years? I plan to hold on to the property for 40 years. Well, that's enthusiastic. She's either had a bad report done, because I know when I get the ones from you, I can see that they go longer.
Yes, when we do them, we project them for 40 years. Now, year 11 to 40 is actually not that difficult because it's not a new depreciation schedule. Year 11 is actually carrying on those numbers from year 10. So in year 11, the same items, if you've still got the same items, you may need some adjustments to it if you've changed what's in there, but that 40-year depreciation on the building is the same every year up until when it runs out. The other items in there, some of them have a life of 10 years, 12 years, 15 years, 20 years, some are 7 years, so some of them potentially are written off. But in year 11, you should be very easily able to, or your accountant, easily able to actually project year 11's deductions, year 12's, year 13's. Now,
look, and if we can explain that to the viewers, it's pretty much because the opening value in a new year is worked out as a percentage of the closing value the year before. It's
now,
like carried on, isn't it?
It is. Depends which method you chose, which gets a little technical, but usually people have probably chosen the diminishing value.
Yes.
And every year there's a residual value left, which is an original value, which is what we come up with at the start, a value on an item. You claim a certain percentage of that, it's the same percentage each year. Under that diminishing value, in year 11, it's just that percentage applied again to what's left.
So let's make it simple with the figure. Just say something's worth $100 and it depreciates at 10% a year, so or diminishing value 10. So after 1 year, 10%'s taken off, which makes it worth 90. So we open the next year with 90, and then $9 comes off.
Yes.
So we open the next year with 81, and then $8.10 comes off.
Yes.
And then so that's how it goes. So the 10% a year takes longer than 10 years because it's off a diminishing value.
And everything in diminishing value does actually take longer. It effectively never really runs out.
Yeah.
It kind of does.
because you get down to like a 10% off 1 cent.
So, and it's always a higher percentage than that prime cost.
Yes.
A prime cost item that's valued over 10, that same item, if it was claimed under that prime cost, would be 5%, and you would get $50 per year, and it would run out.
$5 because it's only 100.
Sorry, $5 per year until it runs out.
In 20 years. So the other thing that people should know, just in case we haven't confused everybody so far, is that once an item gets below a certain number, so that $100 one probably wouldn't be treated like that anyway, it goes into like a basket, and all of those cheaper items go into a basket, and the total value of that basket gets whacked off pretty quick from there.
So once it gets below, actually, under the current legislation, which 10 years ago wasn't quite the same, it drops into what's called a low value pool, and instead of getting its 15% or 20%, it drops into something and gets claimed at 37.5% per year.
Yeah, so that makes it go quicker then, doesn't it?
It goes quicker, but it's still that diminishing value, so it's still only 37.5% of what's
There's
left.
something in the pool. I would have called it a low value basket, by the way. Just, just saying.
The tax office made that one up.
Yeah, pools are bad. Pools are bad way. Hopefully that helps you. Thanks for tuning in. It's time for a break, but when we return, you'll have another chance to get hold of a copy of my book, How to Achieve Property Success, but you will have to ask a question and have it selected. Now, call us now on 1300 30 34 35. Tweet Margaret Lomas AU, making sure that you hashtag YMYC, or you can also email us on property@skynews.com.au. Welcome back. It's great to have you with us this week. I'm Margaret Lomas, and joining me to answer your questions is Brad Beer from BMT and Brian Haratsis from MacroPlanDimasi. Now, I'm sure that you have a question for us, so grab the phone and dial 1300 30 34 35, tweet Margaret Lomas AU, or email us on property@skynews.com.au. And just so that we can start getting some more calls, because you must be all off watching something else, every person who asks a question that we answer on the show tonight, every person we will award a book to. So there's an incentive for you to call in. But before we start taking those calls, in other news this week, CoreLogic has found that across the country, some 2.6 million homes are owned by investors. When cross-referencing property records for indicators including rental advertisements and the owner's address being different from that of the residents, CoreLogic Head of Research Tim Lawless said some broad patterns emerged. First, investors dominated the markets around typically strong rental market areas, such as inner-city locations near hospitals and universities. This included Sydney's Ultimo, North Sydney, Kingsford and Enmore, and Melbourne's Elwood, Brunswick and Hawthorn. In Melbourne, the analysis found it was rare to find a suburb within 10 kilometres of the CBD where investors made up less than half of apartment owners. Nationally, mining regions and holiday areas had a large proportion of investor owners. Apartment investors in Queensland were most concentrated around South Brisbane, Deception Bay and Kelvin Grove. Brad, it might seem a bit counterintuitive, but when I'm looking for an investment property, I try to get in an area, the percentage I like 70% own home owners and 30% investors. I don't like the balance to be much different than that, because I feel that 70% own homeowners gives an anchoring to the suburb and makes it more likely that families will stay there, build a community and a network.
And it becomes people love where they live, and they get much more vested into that area than a renter. And it's really simple. Yeah. It's even in actual apartment blocks or apartment buildings. It's always good to have a mix, and a decent mix of owner-occupiers, because you have some people that actually really care, because this is the home that they've set their roots down, and they've got the mortgage and they're staying here. Yeah. So there's much more care in that area. It's like,
yeah, you tend to get like gardens looked after better and houses looked after better and everything.
And even in looking at some of the areas that I've invested, and I know you have as well, over time, that aren't always the best of areas. Sometimes when public housing is being sold off in numbers, it's an inexpensive suburb often, and often it'll go to owner-occupiers, and therefore they renovate, they make the place better, and they actually start bringing probably not so nice a suburb into being a nicer suburb for the same kind of reason.
Mayfield and Islington are a great example of that. They've both now become quite the trendy area, haven't they? And people would have said no way.
I went to uni in Newcastle, and I've got property in Mayfield, and I was blown away by a valuation recently. And early days, it was like seen as a yucky sort of a spot.
Yeah, it was.
I wish I bought more there.
Yeah, you should have. Hey, that famous last words, I say that about every property that I've ever bought. Brian, do you think that there's some sense to that theory?
Well, there is some sense to the theory, but can I give you like an economic spin on this one?
Yes, please.
Well, the economic spin on it is all about supply. I don't like investing in areas where there's lots of future supply, and the reason for that, I can't control what the value of my property is. So one of the reasons to pursue your kind of strategy is actually typically when it's a 70-30 type split. Often it's because there's a limited supply and the apartment developers actually can't get in. So one of the issues, and I see this all the time with investors, particularly in some of the more central city areas, they seem to, it's like the sheep mentality. They go where the push marketers send them, instead of asking the question, I should be looking at investing in areas where there's limited future supply, because that's where the price increments will be.
And it's interesting because what I find happens with investors is often they're attracted by the big number of renters, because all they can think of is there's a big number of renters there, therefore I'm sure to get my house rented.
That's
But they've got to think about two things. They've got to think about getting their house rented, which is why you don't buy somewhere where it's 90% owner-occupiers and 10% renters.
That's right.
You've got to get it rented in the short term, but it has to grow, otherwise there's no point in buying it.
Well, that's absolutely right. So you need what I'd call liquid markets, and there are optimal points, and they are a little bit different depending on whether there's rail in one area or not rail in an area in one area, because you can get those different ratios happening. But definitely try to look where everyone else isn't.
I feel you wanted to say something there.
Look, I think in those areas where high owner-occupier numbers are, the type of property is probably a good thing to consider. If it's all houses, and everybody that lives in that suburb likes houses, then maybe people don't want to live in a villa in that particular suburb. So considering there's often debate about houses versus units, and I think the demographic of whether people live there and what they are actually living in and want to live in is an more important question than house versus unit.
Absolutely, and in fact that's actually one of the 20 must-ask questions as well. Check what the demographics are going to demand in the future. No sense in buying a unit in an area where you've just got a predominance of families, because you won't have the renters there anyway.
Well, that's exactly right, and you won't have the right social and community networks. Off our market research, when people are looking to decide to stay or move, once they've decided that they want to stay, it's all about the church, the sporting club, the local pub. It's the network.
Yep.
And the problem is, if you've got the network which is all family related, of course, it's not really comfortable.
Yep.
You know, for the rental type accommodation.
Absolutely. Some good advice there. Let's go now to our email, and this one's from Ringo, not the Beagle, who asks, I have just begun my property investment journey with a mind to invest for capital growth. My question is this: how do I know when my property has grown sufficiently in order to refinance and purchase again? I'm going to go to you on this, Brad, because I know that you're a big fan of refinancing, and in the early days when you were in your acquisition phase, every time we turned around you were refinancing so you could buy and add another property. Some of them in Mayfield and Islington, as it turns out, quite a good buy. So what did you do to work out when the time came?
So sort of early days versus now is sometimes probably different. Early days especially, what I was doing, I was buying, and I was always looking for something that had the ability to renovate, that I could see the quick amount, the speedy revalue, get some money back out of that so I could actually keep buying. So I could actually free up as much cash flow as possible, and I leveraged everything really hard at the start. How do you know otherwise? Well, you can look at some automatic valuation type models that exist on websites at the moment to get an indication of what it's worth.
I find some of those way off.
I actually completely agree with you. I think that's a place to start. But you can kind of get an idea of the market of what's there, selling, moving. Like, I keep an eye on the areas where I own properties fairly heavily and seeing what's actually on the market, what's selling.
What's some examples of some of those websites that give you the valuations? It's like On the House and places like that. But they all use the same modelling, really.
A lot of them use the same modelling. The other way is the things like, I think it's Price Finder, and looking at the actual comparable sales in your street or your area will actually allow you now much more than ever to see what's actually been sold in that area. So a valuer goes through a similar process, and you've actually got better ability to get your hands on some of that data now than you've ever actually had. So having a look at some of that yourself, you've got you can, and valuers aren't ridiculously expensive, but if you've got enough indication of where it should be before you've done that by looking at what comparables exist, some of those websites you can dial up or down based on what you actually can see there, and then you can make some sort of decision on whether you believe it's time to go and talk to the bank. The mortgage broker or bank will often have an internal valuation process where they actually have a look at it for you at not a cost. So you've got an option to actually go down that path as well. My other thing is when I do believe there's some there, or really if I believe there's some there, I always revalue and I always pretty much refinance, because when you need the money, the bank probably won't give it to you. When you don't, they probably will.
Exactly. It's good, some good advice there. And I must admit it was the same with my own portfolio. In those early days when I was acquiring property, what I would do is I would make sure that I kept a fairly close eye on the recent sales in the area around my property. So I'd try to find other properties on websites like domain.com and realestate.com.au. I'd try to find those properties that looked like mine in the same area that I could then have a look and see what they were selling for. And there's an area for sold properties on those websites, and get a bit of an idea from that whether it's time for me to call up the bank and ask them to do a revaluation. And it doesn't hurt to do that every now and then anyway. Well, it's time now for us to take a very short break, but when we return, you'll have another chance to ask your questions simply by calling us on 1330 3435, tweeting me on Margaret Lomas AU, making sure that you hashtag YMYC, or emailing us on property@skynews.com.au. Welcome back to the show. I'm Margaret Lomas, and joining me tonight on the show is Brad Beer from BMT and Brian Haratsis from MacroPlanDimasi. We still have plenty of time left for you to call in with your comment or question, and you may even be this week's book winner. In fact, you will be, because all callers, all tweeters and all emailers tonight will receive a copy of my book, How to Achieve Property Success. Simply call us now on 1330 3435, email property@skynews.com.au, or tweet Margaret Lomas, making sure that you hashtag YMYC. Let's go to Twitter, and this is from Gary, and Gary asks, by claiming depreciation on an investment property, does that affect capital gains when sold? Brad, sort of.
Sort of, yes. So when you buy an investment property and you're claiming that deduction on the way through owning that property, some of the claims that you do make on the way through reduce the cost base for the purpose of capital gains tax at the end, should you sell the property. So you've made some deductions on the way through, you've put some cash back in your pocket. At the time when you do sell the property, some of the capital allowances that you have claimed are reduced from that cost base and will increase the amount of capital gains tax you're liable for. Now, when you own the property on the way through, you make these tax deductions at your full marginal tax rate. So you've actually put money in your pocket on the way through while you actually own that property. When you sell the property, the capital gains currently is paid at half of your marginal tax rate. So the money that you do pay in additional capital gains tax by making these claims is generally less than what you actually claimed on the way through by owning the property. So still usually worth doing that. We've sort of run some case studies on that before and crunched out those numbers, and most of the time it does actually work out better.
And Brian, did I interrupt you there?
Yeah, right, and you actually get to put that money back into your pocket on the way through as opposed to later.
So I was going to say, Brian, the time value of money will tell us that $1 tomorrow is going to be worth less than the $1 today, and then what you can use it for today then could be, it can help you buy some more capital assets that might grow, which further increases the value of that $1 today. So claiming it today and getting it back is better than not claiming it.
Oh, absolutely. So, the opportunity cost. And that's the way we look at it, which is there might be an opportunity today, but it mightn't be there tomorrow.
Yeah, absolutely. And look, I just want to say as well that I'm told often by Julia Hartman, who's very good with tax, that if you've got an opportunity to claim depreciation and you know that opportunity's there and you don't claim it, then the tax office may well treat you as if you could have claimed it anyway. So there's not actually an option to not claim it, so you have less capital gains tax at the end. If there's depreciation available on the property, as an investor, it's your job to claim that depreciation along the way and not leave it till the end. So it's a bit of a moot question anyway. David, you're from Cairns. How are you going, David?
Yeah, g'day, Margaret and panel. Thanks for taking my call.
You're welcome.
My question is around about, I have a primary place of residence in the northern beaches, Trinity Beach specifically in Cairns.
Yes.
I've had to move interstate to Northern Territory for work, so I've been renting it out for the last 2-3 years, and I can obviously do that for 6 years. So I was just wondering on what the panel's opinion is on the potential growth out there. One of the off-putting ones for me at the moment is the quite a high rental vacancy rate there, and I've struggled to place the tins just recently. Am I better to hold on maybe and continue out and hold on for that 6 years to get the maximal CGT, or would it be better to look at maybe letting it go now?
Okay. Now, this is a good question for you, Brian. You may or may not know that I've held a property in Cairns ever since I was born.
No, I didn't know that.
It feels. I
You've got property everywhere.
I bought it. It was the first property I ever bought, the first investment property that I ever bought.
Wow.
I paid $161,000 for this unit.
Yeah.
And 3 years later, it was worth $140,000, and I knew that was the commission that I'd paid to the spruiker in the brown suit who sold it to me. However, over the years, it's not really changed. And I'd venture to say if I tried to sell it today, I had it valued a year ago and it valued at $163,000, so I'd made $2,000 on it in 15 years. I've always had a good rental yield on it, but it's been a pretty dud property.
Yep.
And I just feel, correct me if I'm wrong, that Cairns is forever going to be like that, and there'll be little windows where it goes up where you should sell.
Well, that's exactly right. Look, it's been a very cyclical economy. The last time it really took off was in relation to the mining boom in New Guinea, believe it or not. And in fact...
How long ago was that?
It was 2004 to 2006.
I should have sold then.
Yeah, that's right. No, because what happened after that, the prices in Cairns come off well before the GFC. We saw them coming off, and you could see that the whole marketplace had grown way too quickly. The value proposition just wasn't there. As things run at the moment, actually, things are improving a little bit in Cairns. The tourism's actually coming back. The Chinese tourists are back there.
Yep.
And there's some really interesting stuff going on in relation to cruise ships and the proposed cruise shipping in the Trinity River. In the Trinity River, they're looking at new studies to try to work that out. Does that mean you should stay in Cairns? I would think not. My sort of estimation of Cairns is that it's going to remain cyclical. One of the good things about the Northern Beaches is that there's no more land on the Northern Beaches. Sure. The next big move, and you would be aware that the council's been trying to rezone land south down towards Gordonvale in the Mount Peter corridor, but that's very secondary to the Northern Beaches. So you might be saved by the fact that there's not much supply on the Northern Beaches. That might help you. There are some good infrastructure things happening. Chinese tourism's coming back. I don't know what the benefits of the CGT are, so maybe yourselves could help with that. But there are some better fundamentals in this little window that we've got right now.
Okay, look, based on that, my advice then would be this. I would wait and see for now, unless holding on to that property prevents you from taking on another opportunity. I should think if there's an opportunity cost in holding it, for example, you can't borrow any more money or all of your money is tied up in that particular property, then I don't know that there'd be a big difference in selling it now or selling it in 2 or 3 years' time. If you don't need to liquidate that because you can go on and invest elsewhere by either leveraging against that property or you've got other access to being able to invest, then I think I would do a wait and see, but make sure you leave yourself plenty of time to sell it before that 6-year window's up. Now, what you can do, remember, is that you can move back into it after 6 years, providing it's the day before the end of the 6 years, and then you can move back out of it and reset another 6 years. So you do have that little card up your sleeve as well if you wanted to. If in the next, say, 3 years you couldn't get much more out of it and you wanted to give it a little bit longer. What you're trying to do is, I don't think there'll be a big change in the next 3 years, but if there is, then you're still in the market, and that would be when I would take advantage of it. The minute I saw a reduction in days on the market, which is what you're looking for, because that's what tells you that the market's heading up a little bit, an increase in the number of people looking for properties in that area, you can find both of those figures on the real estate websites. Let's go to our email from Beverly, and Beverly asks, is it beneficial to get a depreciation schedule prepared for a newly purchased house in a self-managed super fund, even if it may go into pension phase soon? I'll be buying the house soon. Oh, and there's more. I'm not doing well tonight with this. Secondly, do you think North Lakes area has an oversupply of houses? I heard there are a lot of new blocks being opened up between Burpengary and Decaban. And it's a two-part question, but half each. You go for the first half.
So part one, depending on the amount of time you're going to keep it, the super will have a tax rate of a low tax rate of 15%. So the deductions at the moment, so the deductions that we find in depreciation are a return at a value of 15 cents in the dollar, as opposed to 30, 37, 47, whatever it is, based on your tax rate that you pay. Now, if you're looking at a fairly new property, the first year or couple of years of deductions should, depending on the value of it, be north of or around about the $10,000 market per year, meaning there's sort of the, if it's $10,000, you're talking about maybe a $1,500 cash in your pocket, providing you can use those deductions. Now, in super, you're probably not highly leveraging the amount, so you're going to probably pay some tax on the rental income. So doing it for that short period of time, it's not as good as if you're on the higher tax rate, but generally it will work out. You can get an indication very easily of how much deduction is going to be there before you go ahead with the schedule, or before you even buy the property. And even better, you should be crunching these numbers. So it will depend on that actual time and how much those deductions are.
Brad, I always worry a little bit about when people ask me questions about self-managed super fund. I think it also has to depend very much on the size of your investment into your self-managed super and how many other assets you've got. Because if you're using a lot of people take all the money they've got invested in super elsewhere, roll it into a self-managed super, use all that money to buy a single property. You can't leverage against the growth, so it's like a one-time thing. And then I worry that if that's the single asset of the super fund and you're about to go into pension phase and you have periods of vacancy, then you have no income.
And look, the depreciation component's a simple question, but as far as your self-managed super fund is concerned itself, yeah, it's a very valid point. How much of are you putting all the eggs in the one basket? We don't know that, or the answer to that, but something to absolutely consider. You ask about areas which, Brian, you'll get onto secondly, but the fact that you've chosen the area before, sometimes you look at the fundamentals of what you're looking for in that period of time is a good place to start.
See, this is what worries me about this question, Brian. It sounds to me like someone said to her, well, look, either someone might have said, oh, buy it in your self-managed super fund so you can get in. So it could be someone trying to sell her a property for starters. Or she's thinking, well, I want to buy a property and I can't borrow in my own name, maybe because she's close to retirement. Therefore, I'll whack it in self-managed super. Not always the best way to go. What about North Lakes? Look, it is an area where parts of Burpengary does have a lot of land releases, but it's also a huge growth area, those northern suburbs of Brisbane.
Oh, absolutely. I think there's two separate issues. The first one is North Lakes is North Lakes, and it's actually a better quality. It's a great subdivision. Stockland's done a great job. The shopping centre's fantastic. There's bars. It's a place. Burpengary's not that, and it will be a long time before it is that. And Decaban's the same. Yep. It's just not that. So I wouldn't be too worried about the additional supply, because I don't think it's actually comparable from that point of view.
They're two different areas we're really talking about.
Yeah, absolutely. But but I think the other point, and that's the point you make, actually there's plenty of demand. Brisbane grew at 60,000 people again last year. That is the development front. For Brisbane, you've got the choice between there and Logan. Yeah. That's pretty good odds.
Yeah.
So I think the fundamentals...
And I like them both, but I really love the northern suburbs because, I don't know, there's a bit of a vibe up there.
Oh, definitely. I mean, if you compared, the northern suburbs to the southern suburbs of Logan, I mean, they're just the centre at North Lakes alone. It's just far superior.
I like Logan, though, so careful what you say about my friends in
Logan.
I'm
not saying you shouldn't invest there because there's not much supply. We know that.
Yeah, we know that. That's the thing about it, isn't it? It might not be quite as attractive, but there's not a lot of supply down there in Logan, isn't. So either one could be good. Thanks for tuning in. It's time for a break, but when we return, we will answer any last remaining questions for tonight. So get yours in by calling now on 1300 30 34 35, tweeting Margaret Lomas AU, making sure you hashtag YMYC, or you can also email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it has been a great night with my regular expert Brad Beer from BMT and Brian Haratsis from MacroPlanDimasi. Our lines are closed for tonight, but we have time for these last questions. First of all, Mark from Sydney, how are you going? Mark is not there. So we will now go to our email from Leslie, who says, what is your opinion of buying a holiday rental investment property on the mid-north coast of New South Wales near Foster, Tuncurry, in terms of potential capital gain and rental income? Good one for you. Foster, Tuncurry, again, it's one of those areas, it's not close enough to the capital cities. Employment tends to be a problem, ageing population in both of those areas.
Yes, and for those reasons I don't really like it. It doesn't really qualify for the kind of area where you would get capital growth. The kinds of things that you really need to look for is underlying jobs, underlying wealth growth, or some elements of short supply. So unless you were going for a property which had really fantastic views, which would be one possibility. I wouldn't be looking at it for capital growth at all. And in fact, I'd be worried about it.
Brad, you and I both bought properties in that area, but we both took advantage of just this sort of window. You know, I know my property up there, which is just out of Foster, I kind of got in, it was just an old sort of bit of a beach shack. I got in and got it for 190,000, and then sort of within 3 or 4 years it had gone up to like 800. But that's because of what Brian was talking about. It was like, it's kind of villagey in there, and people were buying the little shacks and pulling them down and building big, beautiful big holiday homes there, and I just happened to get it at the right time. And I think you did a similar thing in Old Bar.
And yeah, so the Old Bar, Wallaby Point, I've got property, and I actually grew up in Taree, which is very close to there. So I know the area quite well. I worked in Foster for a little while. And it's an area, Foster definitely is an area that they built a lot more apartments. There's a lot more money spent on that area, and it's a beautiful area. And if you do find something at the right time that's able to take the advantage like you did, mine haven't done as well as what you have out of that. You've had it a little bit longer. Because you are really stuck with what the local market actually is from a rental perspective otherwise. And I think, stepping back a moment, buying a holiday rental investment, the mistake of actually going somewhere and thinking it's really beautiful and then investing in holiday accommodation there, I started that with mistake, because I know I go places, this is beautiful, it'd be really nice to buy something here. You should invest in what makes money, and then you should use that money to go on holidays where you want to go on holidays, is my opinion.
People often want to do that, don't they? They want to buy in an area. And whenever I get a question like this, Brian, I'm always quite suspicious that the person has selected that area because they think I'll be able to use it on the weekends, or I'll use it when I retire. And the reason why I'm always suspicious is because very few spruikers move in those areas. So it's unlikely you're just going to suddenly come upon that area and think, yeah, this is a great place to buy. It's a dangerous way to buy property.
Oh, look, it's a really dangerous way to do it. But if you want to be close to the beach, there are options. And the real big options are get closer to Sydney. You still go Central Coast, but where there's still good access, good beaches, and you've got the labour sheds. You've got much more fundamentals than you've got there. So yeah, I'd be really worried about buying with your heart in that kind of location, unless, as you say, Brad, it's a great window and you've got something with a really beautiful aspect. I wouldn't be doing it.
Yeah, absolutely agreed. The other thing you need to be careful of if you are about to invest, whether it be in a holiday area or whether it be in an area that has an ageing population, is just that. Look at the population. If it's an ageing population, I'm inclined to stay right away from those areas, because once we've got a population of more than about 45 to 50, if it's quoted as being an average age of 45 to 50, that generally means that most people are around 60. Those people tend to either stay where they are or downsize, so we don't tend to get that property turnover that we need to be able to push prices up. So be very, very careful of those ageing areas. Before we go, we have one last tweet. Now, this is also from Gary, who's tweeted once already. So, Gary, you don't get 2 books, just so you know, but we will answer your last tweet, which is, you said you recently bought and renovated a property, a unit, which is in a 40-year-old block, and do you have access to depreciation under those circumstances? Brad, the block's already 40 years old, but he did renovate it, so what can he claim?
So, Gary, the original structure or the original building will have no actual claim left unless it's had substantial works done after appropriate dates. What we're going to look at for something like that is the money that you have spent, the renovations that have been done. They're all capital improvements that should have some depreciation available. The other thing we're always going to look for is any plant and equipment that is still maybe there. We don't know sort of what extent of renovations you have done, because plant and equipment, if it's got some value, if it's not 40-year-old carpet, we can put some value on plant and equipment that's still there, and make some deductions for those things if you haven't actually replaced them all. So,
Brian, just in regard to those 40-year-old units, there are some areas where there's some little 6-packs or 8-packs of these older style units, so long as they're not too old, that actually do quite well in up against the big high-rises.
Oh, absolutely, absolutely. And so, for example, these days people tend to buy on a per square metre rate. How much is it per square metre?
Yeah.
Well, actually, these are quite big. often quite big.
Yeah.
And so when you have a look at that question of arbitrage, which we spoke about earlier, which is, so what would be the per square metre rate of what I'm buying compared to what I could get in an apartment, you'll find that they'll be quite inexpensive. You'll find they'll rent extremely well. And the other thing I like about the old six-packs, very simple. Not many mechanical parts, not much movement, not much technology in them.
Not big body corporate fees or big sinking funds or
so
anything like that.
It's on the KISS principle. Keeps things very, very simple. So I like them from that perspective. And so, you know, to me, you pick them up wherever you can.
Yeah, there's definitely a demand for that kind of living as well. I think not everybody who wants to live in a unit or needs to live in a unit wants to live in a 700-unit block or a 500-unit block or even a 100-unit block. There's definitely something to be said for those six-packs where, although you're in a unit, you still only have 5 other people to contend with on your body corporate, and decisions are easier, everything becomes easier about that property.
Well, look, it does, and not only that, most of them are normally quite sound. I mean, they're built, you know, the sort of technologies that we use were pretty basic, so you don't really have to worry too much. I mean, if you see some cracking, you ask an engineer and they look at it and say, well, yeah, it's not really a big deal. Yeah. So not really load bearing. Yeah. So there are some very, very good reasons why these are quite good properties to have in your portfolio.
Yeah, Brad, I feel you wriggling. You've got something you wanted to add?
No, I'm fine. I agree. I think your ability to add value is kind of there a little bit as well, because you can renovate in a small block of 6. Even you see a lot of them with simple little things like no garage doors. So actually a garage versus a drive underneath car park makes the whole thing worth. You've only really got 6 people that you've got to deal with that question with, or you might be able to do it yourself if they all agree. Adding value is always something I think is really great, and it's much easier in that small block than it probably is in a big block sometimes. Of
course, one of the drawbacks is when you've only got 5 other people in a block with you, then sometimes the reverse can also be true. If anyone gets behind, then it can be hard, because your sinking fund might get low. I'm in that situation at the moment where there's only 4 of us and 2 people are very behind in their levies, so straight away that makes us pretty well broke and unable to do anything, and it's very difficult to get the money out of them, and you've got to institute legal action to get that money back, and there's a whole lot of issues that go on there. So there's some drawbacks in the small ones that maybe don't exist in the bigger apartment.
Yeah, and I guess depending, I think the ones we're talking here are probably the even older than what you're looking at, that has the very simple old brick construction, 2-level walk up, that maybe doesn't have as much as many of the issues that some of the maybe newer buildings might.
Well, from a construction point of view, I know at least in New South Wales that private certification was introduced about 12 years ago, and since then pretty much 90% of all new apartment buildings in Sydney are leaky buildings that have water ingress issues. Yep. I imagine we have similar issues down there in Melbourne.
Yes, there's been some really interesting work being done recently, inquiring into just what went wrong in terms of the quality of work that was being done. So, yeah, very serious stuff.
It's quite recent. So those older properties don't tend to have that. They've been there for a long time, as you say. They're very solid. They don't tend to get that. The water issues, there's a lot of problems that they don't tend to get.
Yeah, absolutely right. Absolutely right. So, yeah, I think they're very not only very simple, but in a situation where the repairs are easy. Yeah. You can find people that, you know, you don't have to be a mathematician to try to work out how you're actually going to, you know, get the load bearing off so you can actually fix something.
Yeah. And you don't usually have lifts and all those expensive things in those smaller ones as well.
Correct.
Well, that brings us to the end of our show for tonight. I won't be here for a few weeks, but Lisa Montgomery and my friend here, Brad, will be looking after you as they always can. So please be sure to keep your questions coming to me. I will definitely pass them on to both of them to use in future shows. Thanks go to both Brad and Brian for helping me answer your questions this week. I'm sure everyone will agree we've had a great night. We've had some great questions and some even better answers. Thanks also to all of our callers. Now remember, I said that I will give a copy of my book to all of the callers, to all of the email questions and to all of the tweeters. So what you need to do to get that book is to now email me on yourmoneyyourcall@destiny.com.au. You can see that on your screen, yourmoneyyourcall@destiny.com.au. Now remember, this is only if you've had your questions answered on the show tonight. It's not a free book giveaway, so please don't write to me and tell me you want a copy of the free book. It's not a free book, it's a $40 book, but you get it as a prize if we answered your question tonight. Follow me on Twitter, Margaret Lomas AU, and on Instagram, Margaret Lomas Property. And if you want to get ready to leap into the new financial year, get ready to invest, give us a call at Destiny or go to my website destiny.com.au. Now, it doesn't matter where you live in Australia because we can help you. And if you do have a complimentary consultation with us, we'll give you a copy of one of my books valued at $39.95. Thanks for being with us. Don't forget to join us again next week here on Sky News Money.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.